Every day, billions of dollars move through the stock market. People buying, people selling, charts moving up and down every second. To many observers, it looks like a giant casino. Traders trying to outsmart each other, algorithms chasing tiny price movements. But that image hides a deeper truth. The stock market was never designed for trading. It was designed to create wealth. And history shows that those who understand this difference often benefit the most. The modern stock market began for a simple reason. Businesses needed capital. In the early 1600s, the Dutch East India Company became the first company to issue shares to the public. Instead of a few wealthy individuals funding global trade voyages, thousands of investors could own a small piece of the enterprise. Ships traveled across oceans. Spices, textiles, and goods returned to Europe. And investors shared in the profits. That idea changed economic history. Ownership could now be distributed. You no longer needed to run a business to benefit from its success. You could simply own a part of it. Over the next 4 centuries, this system evolved into the global stock markets we know today. Companies raise capital. They expand operations. They innovate and compete. Investors provide funding, and in return, they participate in the growth of those businesses. But somewhere along the way, many people began confusing investing with trading. Trading focuses on price movement. Investing focuses on ownership. That difference changes everything. A trader tries to predict where a stock will move tomorrow. An investor focuses on what a company will become in 10 or 20 years. Trading depends on timing. Investing depends on patience. And history consistently shows that long-term ownership of productive companies has been one of the most powerful ways to build wealth. The stock market creates wealth when businesses grow, not when shares simply change hands. To understand how the stock market really creates wealth, we need to look at how companies grow over time. Businesses create products. They solve problems. They serve customers. When they succeed, revenue increases. Profits expand. Those profits are either reinvested into growth or returned to shareholders through dividends. Investors benefit from both. Share prices often rise alongside business success. Dividends provide cash income from ownership. Over long periods, this combination of growth and reinvestment creates compounding wealth. But this process takes time, years, sometimes decades, which is why frequent trading often interrupts the very mechanism that builds wealth. A powerful example appears after the Great Depression. In 1929, the U.S. stock market collapsed. The Dow Jones Industrial Average fell nearly 90% from its peak. Confidence disappeared. Banks failed. Millions lost jobs. Many investors concluded that stocks were permanently dangerous. But something remarkable happened over the following decades. American companies rebuilt. Industries expanded. Manufacturing accelerated. Consumer demand exploded after World War II. Businesses like General Electric, Coca-Cola, and Procter & Gamble continued growing year after year. Investors who owned shares in strong companies and simply held them through volatility benefited from decades of economic expansion. The wealth created during the post-war boom did not come from trading stocks daily. It came from owning companies that kept producing value. Few investors illustrate this better than Warren Buffett. Buffett is often considered one of the greatest investors in history, but his strategy is surprisingly simple. Buy high-quality businesses. Hold them for a very long time. One of his most famous investments was in Coca-Cola. In 1988, Buffett began purchasing shares after the market crash of 1987. He invested over $1 billion into the company. Instead of trading the position, he held it for decades. During that time, Coca-Cola continued expanding globally. Billions of people drank its products. Profits grew steadily. Buffett's shares increased dramatically in value. But something even more powerful happened. Dividends kept flowing. Year after year, Coca-Cola paid cash to its shareholders. Buffett's original investment eventually generated hundreds of millions of dollars annually in dividend income alone. Not because he traded the stock, but because he owned the business. Despite these historical examples, many beginners still focus on trading. Fast profits, short-term gains, constant activity. The appeal is understandable. Trading feels exciting. It promises quick results. But statistically, the majority of active traders underperform long-term investors. One reason is cost. Frequent buying and selling creates fees, taxes, and mistakes. Another reason is psychology. Humans are emotional. Fear appears during downturns. Greed appears during rallies. This emotional cycle leads many traders to buy high and sell low. Long-term investors often avoid this trap because their focus is not on daily price changes. Their focus is on the underlying business. The 2008 financial crisis provides another powerful example. Global markets collapsed. Major financial institutions failed. Housing prices plunged. Stock markets lost more than half their value. Many investors panicked. They sold their portfolios to escape further losses. But the businesses inside those markets did not disappear. Companies continued operating. They produced goods. They developed technology. They hired workers. Within a few years, markets began recovering. The following decade became one of the longest bull markets in history. Investors who stayed invested benefited enormously from the recovery. Those who exited during fear often missed the rebound. The difference was not intelligence. It was patience. The stock market reflects the productivity of human progress. New technologies emerge. Industries evolve. Global trade expands. Businesses constantly compete to improve efficiency and innovation. When you own shares in companies, you participate in that progress. This is why markets have historically trended upward over long horizons. Not in a straight line. There are recessions, crashes, wars, pandemics. But over time, economies adapt and grow. Investors who remain patient often capture the benefits of that growth. This is the true wealth engine of the stock market. Ownership of productive assets, combined with time. Trading interrupts this process. Investing allows it to compound. The stock market was never meant to be a casino. It was built to connect capital with innovation, to allow ordinary individuals to participate in the growth of extraordinary businesses. History makes the pattern clear. The greatest fortunes in the market were rarely built through constant trading. They were built through ownership. Ownership of companies that kept growing, kept innovating, kept serving the world. Trading chases movement. Investing captures progress. And over long enough periods, progress is what creates wealth.